let's shift focus to the bond markets and the currency market for a smidge. We want to discuss this bond switch, as we've called it. It's a technical. It's really not all that technical a term. The post-Lehman, the government of India increased its borrowings considerably. In the year of Lehman, FY09, the government ought to have ended its fiscal deficit at about 1 lakh crore. It actually ended at 3.3 lakh crore, and the next year it was 4.3 lakh crore. The point is they borrowed a lot for fiscal stimulus. Now, all those bonds, much of them are maturing in FY15. So, whereas, prior years' bond redemptions were always under 1 lakh crore, 70,000 crore for instance this year. Next year, 1,70,000 crore has to be paid back only for past loans. And then you have to borrow for that year. That becomes a load on the market. So the government of India in the budget itself had said that about 50,000 crore of bonds which mature in April, May, June of 14 will be replaced with slightly longer term, switched with slightly longer term bonds which mature in say 2020 or 2025. So it actually is cash neutral for the market because one bond is getting replaced by another, but it sometimes creates a bit of a price fall in the 2020 or 2025 bond because there is too much of it suddenly. It is cash neutral for the market, that is important, and what is even cleverer in this present switch is it happened without disrupting the market. The market didn't even know about it. There was some buzz that it is probably happening as a private placement, but without anyone being hurt, the government of India took out 27,000 crore of bonds that will mature in April, May and replaced it with longer term bonds. Ananth Narayan, the co-head wholesale banking South Asia at Standard Chartered Bank, joins in to tell us the repercussions for the bond markets. Ananth, the market is happy that this is done without disruption, but the fear will be another 23,000 crore will get done. Will it have any ripple effect on the market at all now?
No, I think you got it right, Lata. I think the basic worry is you have 1,68,000 crores of redemptions coming up the next year. And frankly, that's a huge number for the market to digest. So what is going to happen is fine, it will be cash neutral, but there is going to be a large amount of duration which will be supplied into the market. Now, what the government has done is extremely smart. They've quietly reduced some of that issues. But the reality is, it tantamounts to the same thing. You have effectively duration coming into the market. So I think it's going to be very, very interesting to see how this actually pans out. A lot will depend, by the way, on what the next year's fiscal looks like. If the fiscal is under control, then you can still absorb this excess supply coming in on because of redemptions. But if you have a kind of an unstable government and the fiscal being let loose again, then is when I guess the fears will really get aggravated. But make no mistake, I think it is a difficult task for the RBI and the government. There is a large amount of bond supply which is going to come through, not because the fisc itself is going to be large, but because of this redemption pressure, and managing that is going to be a challenge.
Okay. Ananth, hi, good morning. What is your expectation as far as the fiscal deficit target for this year and whether that will be met, and also for FY15? Because, we were speaking with Sonal Verma earlier in the day and she indicated that these are a couple of things that she expects to hear from the vote on account this time.
Right. So, look, this year's fiscal deficit will likely be met. In fact, the indications are given that one of the bond auctions will actually be cancelled. It looks like it will be comfortably met. The question, of course, that we will have is how much of it is just by pushing out expenditure into the next year, and really, what does the next year look like? Unfortunately, while you will have a vote on account giving you some indications, the final indications will come only sometime in June when the new government actually lays bare its actual policy. Now, the risk is, and I guess this is what probably makes India vulnerable both on FX as well as on the rate side. The risk is if you don't have a stable government, then you could have a government that is looking at a short-term 1 or 2 year horizon, and therefore chooses to be profligate and not really conscious in controlling the fisc, as for instance this government has been. So in which case you could really have a bit of issues in terms of a large amount of supply coming into the market. So I think this year should be fine. Nobody really expects the 4.8% fiscal deficit target to be breached. In fact, we expect it to be slightly below the target. The next year will be an open question mark. There will be speculation on that, not just ended by the vote on account. I think it will go on beyond that. We'll probably have clarity only sometime in June. And of course, add to that the fact that you have a large amount of redemptions coming up the next year.
What is the number you're working with? We got a variety of numbers. Jayesh Mehta told us he's expecting the market borrowing to be between 6.25 lakh crore and 6.8 lakh crore. Obviously, the difference being the switched amount. Sonal Verma was working with a 6.6 lakh crore number. What is the buzz on the street? Which number should give the street a heart attack and which should make it happy?
Frankly, these numbers will be in a bit of a cloud at the moment, Lata. We are working with 6.5 lakh crores ourselves. It's a kind of a simplistic mathematics. There's no rocket science behind this. We've just added the net borrowing requirement to the redemptions of 1,68,000 crores. The big question mark really is, will the fiscal deficit target be 4.3% as promised earlier, or will there be some loosening up on that front, which can make the big delta difference really? That we will not have clarity on for a long time now, and I doubt if anybody can throw light on that. It will take time until the new government comes in, declares its policies before we figure out what really is happening there. So look, it will remain a vulnerability for the country. The fact is we have large redemptions. And given that we've got a few populist schemes going through already, and given that we have the burden of the food subsidy bill, which will come in full force the next year, plus of course if you have a short-term government looking at 2 years, willing to open up its purse strings even more for doles, that could really put the fisc under pressure.
Yes, actually there are 2 or 3 imponderables, isn't it? Nobody is talking about the fact that there could be just that 13-day government that was there in 1998, and therefore you're not even getting a budget in June, and whatever you hear on February 17th is going to be the budget for 6 months, for all you know. But anyway, those are other imponderables. A more concrete question to you: what's the bond range up until, say, April 1st, just as a ballpark number, because that's the next credit policy?
So look, from a supply perspective, things look pretty comfortable right now. We have the last auction coming up now, and subsequently no auctions scheduled till the end of the fiscal. So from a supply side, things are looking fairly placid. You could see a bit of a rally coming, a technical rally coming in the bond yields down to maybe 860 or so. But frankly, to me, and we've discussed this before, Lata, I think we still remain vulnerable. The fact is, we still have stretched corporate balance sheets, banking balance sheets. We still have, the fiscal deficit target for the next year is an unknown. We know bond supply is going to be an issue for the next fiscal. So given all of that, I wouldn't jump in and start buying bonds at that particular stage. I would play for a range of between 860 and 880, 890. I think that's probably a fair value for a 10-year yield at the moment.
Yeah, fair enough. Bond markets may take a brief holiday before the worries start accumulating on April 1st. A credit policy and the big borrowing program that will start. Ananth Narayan, appreciate you taking time out for us. Thank you very much for joining.